Have you ever watched gold make a sharp, sudden spike? It breaks a key level only to reverse just as quickly. You might have thought it was a failed breakout. You might have been stopped out of a trade. This frustrating price action is not random. It is often a calculated move known as a liquidity sweep. Understanding this concept is crucial for anyone trading XAUUSD. It can transform your perspective on price action. Instead of being a victim of these moves, you can learn to anticipate and trade them. The market is not just moving, it is actively seeking something out. A liquidity sweep is a simple but powerful idea. Imagine a level on your chart where many traders have placed orders. These could be stop losses or entry orders to buy a breakout. Price will often surge just past this level. This quick move triggers all those waiting orders. To understand a liquidity sweep, you must first understand liquidity itself. Liquidity is the ability to buy or sell without moving price much. Large institutions need massive liquidity to enter or exit positions. If they placed one huge market order, it would spike the price against them. So they look for pools of willing buyers or sellers on the other side. These pools collect at predictable chart levels, liquidity pools. This pool is the fuel the market needs to make its next big move. Where does that fuel come from? From the collective actions of retail traders and other market participants. Most traders place stop losses just above recent swing highs or just below recent swing lows. Breakout traders place buy stop orders above highs and sell stop orders below lows. All those clustered orders make a dense liquidity zone. When price touches the zone, stops trigger and become market orders. Those market orders supply the volume large players need to execute with less slippage. The key difference: a liquidity sweep versus a true breakout is intent. A true breakout is driven by momentum and conviction, breaking a level and continuing with volume. A sweep is manufactured. Its aim is to grab the resting orders. Once the orders are taken, the reason for price being there disappears. That's why the move is so sharp. A quick raid, not a sustained invasion. Price is drawn to liquidity like a magnet. Your stops and breakout orders aren't just safety nets or triggers, they are targets. It's not malicious, it's market mechanics. Large fish feed where small fish gather. Recognize these feeding grounds, avoid being the bait, and learn to trade with the currents left after the hunt. Let's break down how a typical liquidity sweep unfolds on your XAUUSD chart. It follows a predictable 5-step pattern. The first step is the setup. The market creates a clear and obvious price level. This often takes the form of 2 or more highs at roughly the same price, known as equal highs. It could also be 2 or more lows at the same price, called equal lows. This clear barrier is visible to everyone. It psychologically tempts traders to place their orders just above or below it because they believe it's a strong resistance or support level and that if it's broken, it signals a major move. Step 2 is the buildup of orders. As more time passes, more orders accumulate around this level. Sellers shorting gold place protective stop-loss orders just above the equal highs. Bullish breakout traders place buy-stop entry orders in the exact same area. This creates a dense pool of buy orders. The opposite is true for equal lows. A pool of sell orders builds up from buyers' stop losses and bears breakout entries. This concentration of orders is the prize the market will come to claim. The stage is set for the main event. Step 3 is the spike, the liquidity grab. Price moves with sudden speed and force toward the established level. It pushes decisively through the equal highs or lows, often very sharp, on a single long candle. That candle triggers the waiting orders. All the stop losses are hit. All the breakout entries are filled. This injection of volume lets large institutions fill large sell orders at the highs, or large buy orders at the lows, at a favorable price. Mission accomplished for them. Trading a liquidity sweep successfully is not about predicting the spike. It is about reacting to it with a clear and disciplined plan. The first and most important rule is to never enter during the spike. This is the point of maximum uncertainty and risk. It is a trap for impatient traders. Your job is to wait for the market to show its hand. Wait for the candle to close. Look for the reaction. A strong rejection is your first piece of evidence that a sweep has occurred. A candle with a long wick and a small body, often called a pin bar, or a shooting star. Once you have seen a clear rejection candle, wait for confirmation through a market structure shift. Market structure shift, MSS. This is a critical step that adds a layer of security to your trade. After a sweep of highs, a market structure shift would be the price breaking below the most recent swing low. For a sweep of lows, you would want to see price break above a recent swing high. This confirmation helps you avoid trading a simple pullback and focuses you on a true reversal. Now you are ready to plan your entry. Wait for a small retracement back toward the broken level. You can place a limit order in this area to get a better price. Alternatively, you can enter with a market order once momentum of the reversal picks up. Your stop loss should always be placed on the other side of the extreme point of the sweep. Place it just above the highest point of the spike for a sell trade, or just below the lowest point for a buy trade. Finally, you must define your profit targets. A logical first target after a sweep is the liquidity pool on the opposite side of the range. You can also use key support or resistance levels as take-profit points. Always ensure your trade has a positive risk-to-reward ratio. For instance, risk 1% of your account to aim for a 2% gain, or risk 1% to aim for a 3% gain. Wait for rejection. Confirm with structure. Define entry. Set stop. Target. Following this structured plan removes emotion and guesswork from your trading. One of the greatest challenges for a trader is telling the difference between a liquidity sweep and a genuine breakout in real time. The price action can look identical in the first few moments. However, there are key signs that can help you distinguish between the two and avoid getting caught on the wrong side. The most telling sign is the follow-through, or lack thereof. A true breakout is characterized by sustained momentum. After price breaks a key level, it should continue to push in that direction, printing consecutive candles that close further and further beyond the breakout point. Volume can also provide a crucial clue. While the initial spike of a sweep or a breakout can have high volume, what happens next is important. In a genuine breakout, high volume should persist as price moves away from the level. This indicates broad participation and conviction behind the move. In a liquidity sweep, you will often see a massive volume spike on the candle that pierces the level, but the volume will dry up almost immediately on the following candles as price reverses. The behavior of the candle that breaks the level is another critical piece of the puzzle. In a sweep, this candle often closes back inside the previous range, leaving a long and dramatic wick. In a strong breakout, on the other hand, the candle will typically close firmly outside the level. A full-bodied candle closing above resistance or below support is a sign of strength and suggests that the market has accepted the new price and is likely to continue in that direction. Therefore, your checklist to differentiate the two should be simple. Did the price close firmly beyond the level, or did it reject and close back inside? Is volume sustained in the direction of the break, or did it die off after the initial spike? Is price continuing to make new highs or lows after the break, or did it immediately fail and start to reverse? By asking these questions and waiting patiently for the answers, you can develop the skill to read the market's true intentions. A breakout wants to run, a sweep wants to trap. Even with a solid understanding of liquidity sweeps, traders can fall into several common traps. The most frequent mistake is entering the trade too early. Seeing the price spike through a level creates a sense of urgency, a fear of missing out. Traders jump in while the spike is still forming. This is gambling, not trading. The price can always push further than you expect. The solution is simple but requires discipline. Always wait for the candle to close. Wait for the confirmation of rejection before placing an order. Another big error is misinterpreting a genuine breakout as a sweep. Seeing a strong move through resistance, assuming it's a sweep and placing a sell order. Then get run over as price climbs higher. This is a failure to wait for confirmation. No rejection, no market structure shift, clear signals to stay out. If price breaks, closes firmly, and continues with volume, respect the breakout and adapt your bias. Placing stop loss too tightly invites defeat. After a sweep, price can wobble or retest near the spike high or low before reversal. A too close stop will take you out on minor volatility. Place your stop beyond the absolute extreme of the sweep candle. That gives breathing room while keeping risk defined and managed. A tight stop is not always a smart stop. Avoid overtrading. The concept of liquidity is fundamental to understanding market dynamics, especially in a fast-moving asset like gold. Price is not moving randomly. It's seeking pools of orders to feed large institutions. These are liquidity hunts, sweeps. They are engineered to trigger stop losses. They trigger breakout entries. That creates a burst of volume, which often precedes a major reversal. Learn to see the market this way, and you stop reacting to traps. Stop being a reactive trader who gets caught. Become a patient strategist who capitalizes on them. The patterns are there for those who know what to look for. Stop chasing spikes. The initial sharp move is the trap, not the opportunity. The real trade is the reaction that follows. Build your strategy on patience and confirmation. Wait for the market to complete its liquidity grab. Wait for a clear signal of rejection. Wait for a market structure shift that shows change in control. Only then, with evidence aligned, execute your plan. Have a clear entry. Have a defined stop loss. Have a precise target. Discipline separates consistent traders from the crowd. Checklist. Identify a clear liquidity pool. Watch for the spike through the level. Wait for a candle to close. Look for a rejection wick. Confirm the reversal with a structure shift. Only then, enter and place your stop beyond the spike's extreme. This methodical process builds confidence and consistency. Practice on a demo account. Go back through your charts. Identify past liquidity sweeps. Study how they formed. Study how price reacted afterward. This trains your eyes to spot setups in real time. If you want to understand gold professionally, subscribe to Forex Wizard. More advanced XAUUSD breakdowns are coming next. Trade smart. Stay disciplined.